Welcome to Goldenrecord, an S&P Market Intelligence podcast, where we discuss challenges, solutions, and hot topics in the world of corporate actions. I'm your host, Amanda Burgess, from the Managed Corporate Actions business within S&P Market Intelligence. In today's episode titled, Are Recession Concerns Inflated?, we discuss why current market conditions have many experts predicting a recession, how corporate actions are impacted, and why advances in tech and data may change the way the market reacts to inflation's first major debut in the internet age. My guest speaker for today is Chris Fenske. He's head of capital markets research for S&P Market Intelligence's Global Markets Group, where he focuses on combining data sets with financial and capital market data to provide insight into the liquidity and performance of investments. Prior to joining S&P Global, Chris was a portfolio manager, overseeing $1 billion distressed mortgage-backed securities at a New York-based hedge fund, and held trading and research roles at Credit Suisse.
Thank you, Chris, for lending your expertise to the conversation.
And thank you, Amanda. Thank you very much. It's a pleasure to be on your podcast today.
So today we want to discuss the current economy, financial markets, and emerging tech, with an aim to provide listeners with helpful insights as we navigate through new challenges together. Just as we're all recovering from the pandemic, we're now facing inflation, disrupted supply chains, and a potential recession that's impacting businesses and individuals across the globe. So what do you qualify as some key market themes for the second half of 2022?
Well, Amanda, for starters, current global markets look like a flock of black swans flying towards a hurricane. As the world navigates the first global pandemic in over 100 years, the first major European war since World War II, and the highest U.S. inflation in over 40 years. For starters, U.S. consumer price increased 9.1% year over year in June. With such high inflation driving borrowing costs significantly higher in the first half of the year, yields on the 10-year U.S. government bonds are actually 100 basis points higher than how they started the year. There's also a high potential for an energy crisis in Europe going into the winter months or even sooner. There's a higher probability of some degree of global recession and credit concerns that come with it, which has the potential to drive rates lower on a flight to safety. And then lastly, U.S. dollars at its strongest level since 2002, which has the wide sweeping implications for the profitability of multinational corporations, negative implications for U.S. exports, and could also weigh heavily on emerging market economies.
Okay, that's a lot to sift through. We'll see how far we can get today. Let's start with inflation. Pre-COVID, inflation was very low. Can you pinpoint why that was and break down the impact of COVID on inflation? And then, of course, subsequent factors that continue to agitate the situation.
Okay. A couple of the key drivers of what drove inflation lower before the pandemic, for starters, very cost-efficient supply chains, bare minimum inventory on hand to meet manufacturing demand. So keeping low inventory or just enough inventory to produce your goods leads to lower costs. Secondly, and this is a major one, and we talked about before the internet age, and you mentioned in your title, but the Amazon effect has provided price transparency and globalized virtual storefronts. In the past, you need to drive to like 10 stores to find the best price. Now you can look for the best price across hundreds of stores across the globe and never step out of your house. And that's pretty powerful. Favorable demographics from an aging population in the US, Europe, and Japan, as older consumers typically spend less and invest more in bonds. This all keeps inflation lower. It also keeps rates lower as well. As far as how COVID accelerated inflation, central bank rate quantitative easing programs led to low to negative borrowing costs. That incentivized spending and increased investors' appetite for higher yielding and riskier asset classes. Global shutdowns, non-essential industries that increased physical interactions like travel and payments, created significant pent-up demand for those services once restrictions were lifted. Everybody wants to get on a plane right now and go somewhere. The last time we had a real summer was 2019. Right. Increased savings rates from shutdowns coupled with government stimulus fueled further demand further. And then lastly, underestimation of the speed and ferocity of the post-COVID recovery led to either delays in ordering critical components or under-ordering of parts. The first thing that comes to mind is the automotive semiconductors. Here's some other things that are impacting inflation, probably even more recently. So the Amazon effect brings prices down, but when there's shortages, the Amazon effect actually brings prices up. So you have a scarcity of goods, and you basically have people bidding for those goods and willing to pay higher prices for that lower number of goods. The Russia-Ukraine conflict drove up prices of food and energy, with sanctions on Russian oil having an immediate impact on refined products like diesel and gasoline. Once you stop importing a specific grade of oil, refineries have to reconfigure to be able to handle other types of oil. Oil's not as fungible where you can just put any oil in any refinery to produce diesel or gas or jet fuel. The surge in rehiring after lockdowns led to labor shortages, which then led to higher wages, which increased demand further. And then lastly, increased the commodity price and labor costs drove up the price of new homes, coupled with the shortage of houses on the market for sale, drove up U.S. home prices.
Those are some strong points. Let me ask, which sectors in your view are or will be impacted the most by inflation?
It's hard to zero in a specific sector, but I mean, for starters, I would say, large cap companies are less impacted, given that a large company has more pricing power than, a smaller cap company where there's, different levels of supplier agreements, maybe potentially less sufficient supply chains. But I will add to that too, that even for the large suppliers of consumer staples, they could lose some market share to some of the more generic type brands, in these higher inflationary environments. In addition, commodities, tend to be somewhat insulated from inflation. So oil, metals, mining, sectors like that typically do better in an inflationary environment overall.
So let's pause for a moment to discuss these small business owners. I came across an interesting article highlighting the different aspects of inflation and how it's not all bad, and how it can impact different businesses in different ways. The article was centered around a February 2022 survey that was performed by the U.S. National Federation of Independent Businesses, NFIB, where they reported that 26% of respondents named inflation as their single biggest problem more than any other. It was followed closely by the quality of labor, but in the previous year, only 2% named inflation as a major concern. This only solidifies for me what Chris was just saying about economy of scale being a major factor. The article also covers which industries are impacted most, which is what Chris and I talk about next. I'm sure there's a measurable difference between the impact of inflation on different industries, specifically mandatory versus voluntary, for instance, your essential goods, groceries, gas, doctor visits. That's what the general public is going to prioritize, where there needs to be a choice over discretionary goods.
So discretionary spending is a good point. Consumer staples typically do pretty well, although there's a lot of times there's a move towards more generic brands, in the case of inflation and higher prices. Discretionary, yes. So, if more of your money is going to, gasoline or to your staples, then there's going to be less money for consumer discretionary items. That's correct.
Do you think this will have a significant global impact, or will some countries feel it more than others?
It is definitely a global impact. It's definitely felt probably the most right now in the US and Europe. China's been in a bit of a slowdown, partially driven by the COVID restrictions this year. So they're not feeling it as much as others. And most importantly, and the most concerning part where it's felt probably the hardest is a lot of the emerging markets in the form of, these higher energy prices, and more importantly, the higher food prices. So they're the most sensitive, where they have the least amount of cushion or government support to help people through these higher inflationary cycles.
Okay, so would we talk about, Europe and the United States feeling the most so far? When do you think the European Central Bank and the Bank of England will catch up with the Fed, or will they?
Well, actually, the Bank of England actually acted first. They had the first tightening across all those three central banks back in December, and then they actually had their first back-to-back tightening again in March. So they acted the first. But the Fed is acting the most aggressively as far as increasing the fastest and the highest magnitude to temper inflation. ECB's a little far behind. They're going to be raising rates. It's expected they'll be raising rates shortly. They have a different situation than the U.S. as far as the impending potential gas crisis in Europe, which is already starting to slow down the economy to some degree. So, but they're running into the same inflationary issues as others, but they're in a different situation than the U.S.
Yeah, thanks for shedding light on that. So, in the near term, what would you say is going to determine the path of how much higher rates go in an already high interest rate environment?
I mean, for starters, I would say that, we're not really in a high interest rate environment by historical standards. 1980s, you're talking double digit type interest rates, 13% mortgages. So we're not that high yet. Obviously, we're a lot higher than we were a year ago. The main drivers in the short term, obviously, inflation is the number one driver in the next couple of months, to see where inflation goes, if it tempers, if it stops increasing at the same pace. That's one in the near term. Secondly, pushing back against inflation is potential recessionary pressures. So an overall slowdown will actually decrease demand for goods, which could potentially drive prices lower as well. And then all in the backdrop of this, the path of energy prices, gas and oil, as far as if they continue to increase, if you see potential shutdowns of industries in Europe from some sort of gas rationing, that could put pressure on supply chains, which could, further increase prices from that perspective. So yeah, I would say supply chains are also a factor too in the near term.
So you say current interest rates aren't high. Do you think we're all just feeling that way because they were so historically low a year ago?
A year ago, the past several years, they've been historically low. So but markets feel the change in interest rates more, in the trajectory. Once interest rates stabilize, from a fixed income perspective, you want higher rates on bonds. It could actually definitely rejuvenate that sector. It's just the change in rates, and it's got to stop increasing, or the slowdown of increases, which will actually, be well received by the markets.
So earlier we talked about how inflation impacts different businesses in different ways. So who's doing well in all of this? As we would expect, energy stocks have jumped with elevated gas prices. Do you think shareholders can expect an increase in distributions, or do you predict energy companies will invest additional earnings into more drilling to keep up with demand?
So, for starters, so maintaining discipline in U.S. oil and gas production at current oil prices, coupled with government pressure to pump more to temper gas prices, that may be difficult for producers to make the decision not to produce more or invest more in their production facilities. Most producers are profitable above $60 barrels of oil. So every dollar above that level increases free cash flow. And that free cash flow can be used for CapEx, so building more oil pumps and investing in their infrastructure, increasing dividends potentially, or even accelerating the pay down of debt. That sector is a large part of the U.S. high yield bond market sector, oil and gas, and it's had probably, I would say, by far the best performing fixed income sector potentially in the world over the past couple of years is the U.S. exploration and production high yield public debt sector. So that free cash flow is a big part of that.
So the looming question of a recession. Countless financial experts and economists recognize the issues that we've been talking about today as strong indicators that a recession is likely. The Wall Street Journal cited a Federal Reserve economist when they published, I quote, "A slightly more than 50% chance of a recession over the next 4 years and a 2/3 probability of a downturn over the next 2 years," end quote. The analysis was based on 4 variables: the unemployment rate, the inflation rate, the difference between yields on Treasury securities and investment-grade corporate bonds, and the difference between yields on short and intermediate dated treasuries. How do you see these economic issues directly impacting consumers, investors, and business owners in ways that point to a recession?
Okay, for starters, U.S. employment we're near full employment, historical low unemployment. That's a huge tailwind to the economy out of the gate. So we're going into this from pretty strong footing. But on the other end of the spectrum, higher inflation, higher energy prices beginning to weigh on consumer demand for other goods. But as I mentioned before, this is the first real summer since 2019. So people appear to be spending on travel and experiences. There doesn't seem any shortage of that. It could be a short-term surge in the summertime and maybe feeling the pain in the fall. It's hard to say at this point. I mean, central banks are increasing rates to battle inflation. They're unwinding qualitative easing programs. That could suppress demand further too by higher borrowing costs, higher cost of capital. I mean, higher rates are rapidly increasing corporate and consumer borrowing costs, which could drive defaults higher too.
So how is this all going to impact the capital market activity? We've seen that capital raising has slowed down significantly across all asset classes. Do you anticipate increased activity on capital restructuring or maybe even reduced distributions?
I mean, out of the gate, I mean, a large part of corporations' borrowing needs are actually met during the ultra low rate environments of 2020 and 2021. I mean, rates are much higher now, and credit spreads are noticeably wider given the recessionary concerns. That could actually block weaker credit borrowers from the public markets. You're already seeing in the U.S. high yield markets where high yield issuance is down significantly versus last year. If that continues, then the ability to refinance debt could be more challenging. I mean, in addition, I mean, issuers that actually have bonds that are outstanding that are callable at any point in the near term may actually decide not to call their debt. So you have extension risk where your bond is no longer a one-year bond because it's being run to call given the current interest rate environments. Now it becomes a 5-year bond, given that the issuer is not going to call it because the coupon is out of the money versus where they borrowed at the time of issuance. As far as M&A goes, I mean, higher rates and potentially wider credit spreads can make leverage buyouts more challenging to execute. I think an even bigger headwind is that there's a lot of additional scrutiny by US and European regulators on large-scale M&A that takes out significant amount of competition out of a sector. So they want consumers to have options or industries have options. And M&A, especially large scale, could take some of those big options off the table for consumers. And then in the event of a recession, I mean, capital restructuring should increase, but it's way too early to tell which sectors will be impacted the most.
Mm-hmm. We, in our MCA monthly blog, recently had an article specifically around how inflation and potential recession are impacting corporate actions. And one area where we saw a significant decrease is in successful SPAC deals. So, given the current economy and how the stock market's been performing, investors are a little more weary to be jumping into those more risky investments. So we're seeing those SPAC deals be abandoned for lack of options, basically, and lack of investors. So that's one. I will be interested to see, a couple months from now where we can really compare statistics over the first half of the year in 2022 versus 2021 and see, what mergers and maybe distributions even were canceled as a result of these economic factors. So,
Amanda, I want to add also, ironically, 3 years ago, I mean, the restructuring market was dominated by exploration production energy companies, where there were debt haircuts, maturity extensions, coupon holidays, things like that. You could not imagine today, with $110 barrels of oil, anybody having to do a restructuring on the oil and gas side at this point in time. So it's interesting how a couple of years ago, it dominated the market, and now it's you'll rarely hear of a debt restructuring in that sector. Times change quickly.
Mm-hmm. So we chatted about this prior to recording this discussion today.
Mm-hmm.
You were talking to me about the democratization of data. Can you talk about that here? I want to focus specifically on, what has changed in this space over the last 4 decades. You've noted several times throughout the conversation that this is the first time we've seen inflation rates this high since 1982. So where are we now versus then?
I mean, world's obviously a lot different place now. I mean, and as you mentioned, democratization of data is a big part of it. I mean, there's much lower storage costs today, led to the digitalization of everything that can be collected from a data perspective. The internet allows for real-time collection of exchange data and knowledge from across the globe. I mean, back in the 1980s, if you're collecting corporate actions, you're looking at 5, 6, 7, 8 newspapers the day after they're printed to basically collect the information. You have probably a highlighter, you're typing it in a typewriter. Things are a lot different. There's also a lot less data asymmetry in the financial markets. Right now, I probably have more access to data than a lot of the financial analysts or the portfolio managers did in the 1980s, just at my fingertips right now. And I'm just an average retail investor. It's a lot different now.
With an iPhone is going to have more than an investor did in the 80s.
Your iPhone is hundreds of times more powerful than any computer that they used in the 1980s as well.
Right.
Another part too is, advances in the production of data. In advances in pricing over-the-counter fixed income markets, that's enabled indexation in fixed income, which then enabled the bond ETF market, which has grown significantly over the past 20 years. Natural language processing, multi-sourcing has improved the accuracy and timeliness of corporate action reference data. So, instead of a person manually scribing through a printed prospectus, this is all done through natural language processing, where the system can actually learn which language to look for and then parse it out, error-free, to make a much cleaner record, a golden copy of those data sets. And you can't forget about the improvements in the analysis of data. Part of it is hardware. There's been leaps in processing power over the past 40 years. You can't do artificial intelligence, machine learning without super strong data processor or even big data analysis. So that's a big part of it too. Then also the advent of bond portfolio trading improves liquidity, and the ability to move, 1 billion in bonds and sell it, within hours. It takes a lot of technologies. It takes automated credit scoring. Evaluated pricing is also a key component of that. And then lastly, and this is actually touches on the role that I'm currently in within our global markets group, the electronification of bond primary and secondary markets makes those markets much more efficient, adds liquidity to those markets where, a new issue is done through an electronic platform, whether it's municipal bonds, corporate bonds, even equity IPOs. It leads to better execution in many cases. It makes the workflow much more efficient for the syndicate desks, which generally helps the market overall. In closing, the benefits of now-time data to the global financial markets could lead to subduing inflation without causing too much harm to the global economies, which wasn't really possible back then. So, we're in a much better place now than in the 1980s to combat rising inflation, which would likely, give the central banks and the decision makers the ability to act just at the right degree without creating any type of major, financial crisis.
Yes, let's hope so. Well, you've given us so much to consider. I thank you so much for your input and your time.
Thank you, Amanda. It was a pleasure being on your podcast today.
If you want to learn more about what Chris's team is doing that might help your business, his profile is available in the episode description. Check him out.
As for MCA, as always, we're in tune with the market impact on corporate actions, ever committed to providing customers with up-to-date and timely corporate action details. If our data solution is what you need, you can contact our team of experts from the link in the podcast description. Now, do you have a topic in the world of corporate actions that we should be talking about on this podcast? We want to hear from you. Send an email to goldenrecord@spglobal.com with your suggestions. Thank you for joining today. We'll be back soon. Keep listening.